Hey everyone, and welcome back to another innovative investment idea. My name is Dave, and in this video, I'll be going through part 1 of a 2-part series all about my post-pandemic growth portfolio. I'll talk about what stocks I've been buying since March and how I expect each holding will do moving forward. But before we get started, don't forget to hit the subscribe button if you're new to the channel to get more stock market content just like this. Like most active stock investors, especially in the 20 to 40 age bracket, I've been a busy bee the last 2-3 months, rebalancing my existing portfolio to shed underperforming stocks due to the pandemic, cashing out on stocks that I think had exceeded what I view as a fair price, and on the flip side, snapping up as many new stocks as I could where I felt the valuation was enticing enough or there was significant potential for future growth. It's important to highlight the difference between trading and investing. And while I do engage in short-term trading in limited capacity, the majority of my capital and in turn my investing style is predominantly with a longer view. Additionally, as will be fairly obvious as we progress through to the end of the video, I also tend to have a heavy bias towards technology-based companies, which I think are pushing society towards the next frontier, and not nearly as much towards beaten down stocks such as those in the financial or travel industry, like some of the millennial traders referenced in this article. As a quick recap, in case you've been sleeping under a rock the last 3 months, the Dow Jones, along with every other market index, hit its lowest point in almost 4 years on March 23, 2020, shedding close to 40% of its value in the span of only a month. Since that time, however, it has come roaring back to around 25,000 points as of recording, soon to eclipse even the previous all-time highs if the market continues its overall bullish trend. With that said, for the past week or so, with the number of daily cases of the pandemic gaining momentum, and in fact hitting record levels on June 26th, confidence in the market seems to be once again wavering, and there are some indicators, such as the rise in the UVIXI, that are hinting we could very well see another sizable pullback soon. But whether or not we see a major correction come to fruition, most savvy investors would agree anyway that potentially 95% of the stocks in the market are currently overvalued relative to corporate earnings. So now is actually a precarious period of time for investors, and we all should tread carefully and really assess the composition and future direction of our investments. As the viewer, if there is one takeaway from the video at all, is that you should be reminded to think about how to structure your investments so that you won't fall victim to a collapse, and at least have a plan or vision for how to grow wealth in the long run. Obviously, it's impossible to know for sure if there's going to be a dead cat bounce, a second wave of the pandemic bigger than the first leading to another vicious sell-off, or precisely when the global economy will regain its legs leading to organic corporate growth as opposed to being boosted by artificial activities from the Fed. But we can of course look at some of the readily available data in an attempt to prognosticate certain aspects at least. As such, I suggest that there are 3 things that we are definitely sure of which may help us collectively to make better future decisions before I unveil my portfolio. So number 1, until we develop a vaccine, and it could be a while, the global health issues are not going away anytime soon. Here's a list of every vaccine used in the US today, and despite centuries of scientific, technological and medical progress, it only contains 26 entries, a mere 26 of all the estimated tens of thousands of diseases and viruses in existence that directly affect humanity. Without making this video into an entire lesson in epidemiology, since the focus is clearly on stocks, vaccines have historically taken numerous decades and sometimes even centuries to develop. Smallpox, for example, wiped out an estimated 300 to 500 million people just in the last 100 odd years alone, and traces of it have been detected as far back as ancient Egyptian society, circa 1000 BC, but a vaccine wasn't produced and in widespread use until approximately the 1950s, and the virus eventually eradicated in 1979. On the path towards a vaccine, a British doctor by the name of Edward Jenner was able to demonstrate that a much less deadly variant, namely cowpox, could be injected into humans to convey immunity way back in 1796, and incidentally, the word vaccine derives from the Latin word for cow. History lesson aside, the takeaway for investors is that the first cure to one of the worst pandemics ever wasn't resolved for 150 years between Jenner's discovery and when scientists and doctors could actually muster the resources to produce a V-shot. Of course, 150 years only if we discard the few thousand years of human suffering before Jenner's discovery. Obviously, with much better technology here today in 2020, the sheer scale of engagement by businesses and governments worldwide, sophisticated and precise techniques, in addition to powerful equipment and immense computing power to help crunch data, it's not likely that a vaccine to the current global health issues will take 1,000 or even 150 years. But even if humanity manages to conceive of one within 1 or 2 years, that would be a massive, unprecedented feat in of itself. So just to re-emphasize the original point, this global health issue is probably not going away anytime soon. Number 2, society isn't going back to how it was before March 2020 until number 1 is fully resolved and billions of doses are administered. This means traditionally robust sectors such as retail, hospitality, travel, real estate, and entertainment will continue to struggle to some degree and will need to undergo massive reforms to cope with the new norms, even if it's not reflective in today's bloated stock prices. At the very least, the volume of revenues in these sectors could see a noticeable decrease from pre-pandemic levels. Technology and cloud-based stocks, on the other hand, should see their growth accelerated due to the clear shift in a society where social distancing and minimal human contact becomes the standard. The quicker we, as a society, accept these changes, adapt our practices, and stop backward looking, the faster corporations in America, and globally for that matter, can go back to what they do best, earning money, or at least figuring out how to earn money given the parameters of the game. And the third and final point, with the Fed pumping in already an astounding $7 trillion into the economy, and even expanding its activities to prop up potentially zombie corporations that might end up defaulting anyway, there is no doubt in my mind at least, that there is going to be significant inflation in the medium to long-term future once the dust settles. Right now, because consumer spending has dried up and most of the money is being piled into corporations, the extra cash is mostly out of mind, out of sight. By the way, I discussed the Fed's activities since March in a previous video, which should be appearing in the top right hand corner if you want to check that out. As a reminder, inflation is generally defined as a rising cost of a basket of selected goods over time, but until society starts spending money again and the wealth begins to shift from Wall Street to Main Street, the cost of that basket won't likely to be going anywhere, at least in the short term. But if we suppose for a moment that over the next 3 to 5 years, employment rates possibly return into pre-2020 levels and corporate earnings start growing again, inflation should manifest itself in a very big way. While there is not much to do at this point in time, it is definitely something to be aware of and serve as a reminder to reassess our investments down the road in a few years perhaps, once this becomes apparent and a potential collapse in the US dollar is on the cards. Okay, so having now set the stage and expectations, I will go over just the growth portion of my post-pandemic portfolio and talk a little bit about why I bought into various stocks, when I entered into the position, and my view on their respective potential future performances. I will abstain from discussing any dividend or value stocks I've accumulated over the same time period, however, but if there is significant interest in the comment section below, I might consider making a video focused just on that in the future. If you have followed the channel at all in the past and have seen some of the previous videos, you should already be able to guess at least the first 3 major holdings and have an idea of my bullish thesis behind each. But for the benefit of everyone else, the first major holding in my portfolio is the trade desk, ticker symbol Tango Tango Delta, which constitutes a healthy 10% of total holdings. If you're interested, a card should be appearing in the top right hand corner now to a video I created a few weeks ago that covers this company in great detail. While the trade desk operates in the marketing and advertising segment as one of the major demand-side platforms, in a very real sense it is also a technology company. Despite having existed for only a handful of years, it has already developed a competitive advantage through the use of a patented artificial intelligence platform to conduct advertising across multiple channels such as podcasting, traditional online media, social media, and connected TV on behalf of its customers. This one graph on worldwide ad spending trends illustrates in particular the digital advertising industry's future trajectory. The suggestion is that today in the year 2020, companies are spending $380 billion in digital advertising, but that figure is projected to head well north of over $500 billion by 2023 and represents 60% of total ad spending. Or in other words, an absolute increase of over $150 billion in the potential total addressable market, of which TTD should get its fair share. Even if the pandemic manages to keep businesses closed for a prolonged period of time, and digital ad revenues undoubtedly take a hit in the short and medium term, it seems unlikely that it would affect the longer term of say 3+ years, as the shift to digital advertising is gathering steam and seems undeniable. In fact, according to Yahoo Finance, an aggregate of 17 analysts have already set a sales growth target of 35% for the upcoming year 2021 for TTD, and depending on how the global health issues shake out, I suggest it could be significantly north of that. If growth ends up accelerating sooner rather than later, we could see a string of significant earnings beats and overall increase in net income for a company that has already become extremely profitable since it went public, and subsequently the stock price could skyrocket over the next 3 to 5 years. Since I was fortunately able to acquire all of my current holdings in early April, my cost basis is around $180 to $190, which means I have already enjoyed significant capital growth, but due to the meteoric increase, I've actually had to sell off a few units to maintain my 10% weighting. Looking at the chart, most investors might be tempted to think because the company has already grown 20x since the IPO that it might have run its course, but with the aforementioned trend towards digital advertising, I'm convinced this stock has plenty of gas left in the tank, and as a reminder, only went public 3 short years ago, meaning it has yet to hit its potential apex. On any kind of significant pullback or correction, I'm definitely looking to add to my position here, and even for investors with no position, this is definitely a bright future growth stock to watch for the next 5+ years. The next stock, which also constitutes 10% of the portfolio, is software company Alteryx, ticker symbol Alpha Yankee X-Ray. Like the trade desk, I've also previously covered this stock if you're interested, and you can click on the card appearing in the top right hand corner now for a more detailed analysis. But in short, Alteryx has created a data science and analytics platform, helping companies and even industries improve their efficiency and effectiveness in a time where data is becoming the most valuable commodity in the world. If you've ever worked in a big company before with many departments, branches, and offices all over the world, you'll no doubt have first-hand experience into how much data is kept within pockets or silos of a business, with some information in Salesforce, for example, some in a database server, and more still in Excel or some other repository altogether, and there is usually no way to get an aggregated view of the entire dataset. In an attempt to address that particular gap in the market, Alteryx, however, has built a robust and rounded toolbox that allows data analysts and scientists alike to not only connect all of the disparate sources into one communal location, but also visualize and represent the results. In fact, the company has already managed to penetrate 37% of the Global 2000, and their 6,400 customers it boasts includes many household brand names as pictured here. There is still a lot of room to run here, as Alteryx is well known for its 130% expansion rate, which means existing companies are increasing their year-over-year spending by an average of 30%, and because of its software as a service or SaaS business model, it rarely suffers customer attrition. Now a quick glance at Yahoo Finance again reveals strong projections for 2021 and even the current year 2020 despite the pandemic, and after its recent Q1 earnings, reported an increase of 43% year over year, suggesting it still has huge growth upside. This was another stock I got into fairly early on during the initial recovery period, and was lucky enough to acquire all of my current holdings off the March lows with a cost basis around $100 to $110. Like the trade desk, it too has already become profitable in the 3 short years since it went public, and should see nothing but even greater growth over the next decade plus. Definitely one for the hold and stash category, even at the current prices in my opinion. The third stock in my portfolio was actually the first company analyzed when the YouTube channel started. The video and sound quality is perhaps a little suspect, but fortunately I've come a long way with regards to video editing and overall quality, but more importantly, no news since the release of that video has derailed Beyond Meat, a company focused on producing plant-based protein alternatives, from my initial bullish thesis, and in fact, probably more has happened to reinforce that belief that the company will continue to grow massively over the years to come. So ticker symbol is Bravo, Yankee, November, Delta. On June 8th, news broke that Beyond Meat had signed a partnership agreement with Synodus, one of the leading distributors of imported food products into China, a deal that could see both Beyond Beef and Beyond Burger being sold to over 4,500 wholesalers, restaurant chains, and hotels throughout the country. This came a week after the company had already announced that it had initiated plans to strengthen its foray into China by also partnering up with Yum China, who is the regional owner of the KFC, Pizza Hut, and Taco Bell brands. With close to 10,000 restaurants across China, if the Beyond Meat products prove to be popular amongst fast food goers, could be another huge gateway into the world's most populous nation, and thereby biggest total addressable market within the food industry. Of course, we should also rewind back to when the entire movement into China started, way back in April, when the company announced it had signed with Starbucks to begin selling its products to all of its locations in the major cities. With China already well ahead of the curve in terms of a nationwide recovery from the pandemic, the early signs are positive that the food industry has been able to reopen, allowing Beyond Meat to get into the mix. The company is undoubtedly playing a numbers game, and if even one of these 3 deals pays dividends, it could be a huge win for the company in the long run. Of course, it hasn't been all great news in recent times, and I would be remiss to not mention some of the negative news that has come out as recently as June 25th, when closer to home, McDonald's Canada announced it had ceased relations with Beyond Meat and currently has no further plans to sell its plant-based products after the initial trial period elapsed. Despite this setback, my overall belief in the disruptive nature of the company, combined with the unsustainability of the livestock and meat industry due to its serious negative impact on the environment, makes me a believer not just for ethical reasons, but also in terms of secular global trends. The parallel I tend to think of is with fossil fuels, and although the transition has been painful and drawn out over the last several decades, we are certainly now moving away from environmentally polluting vehicles and entering an era where electric car maker Tesla has become the largest automotive company in the world by market cap. The stock price took a bit of a tumble in addition to the wider market losses throughout the week of June 22nd, but as with all the growth stocks that have been and will be mentioned, short-term volatility is definitely to be expected. I got into this stock a tad late, essentially right after the stock gained a massive 25% after a huge earnings beat at the end of Q1, with my cost basis somewhere in the 120 range, so I'm only marginally up at this point. Nonetheless, I would definitely consider picking up additional shares if the price were to drop below my initial entry, and for investors currently on the sideline, it's certainly a stock worth monitoring. The next holding is Facebook, ticker symbol Foxtrot Bravo, a company that almost needs no introduction. During the last reported quarter, the company revealed that almost 3 billion people were using at least one of Facebook, WhatsApp, Instagram, or Messenger each month, which of course means a huge network for advertisers to leverage. And considering it has yet to figure out a means to monetize either WhatsApp or Messenger effectively, tells us that it still has a couple of tricks up its sleeve. It is the owner of the biggest social media platforms in the entire world, and alongside with tech titans Google and Amazon, controls 70% of the US's digital advertising revenue and somewhere in the neighborhood of 55% worldwide. It will undoubtedly take a hit to its top line in the coming year, with digital advertising for 2020 in general being hampered by the pandemic alongside the trade desk, but again, in my estimation, this is but a small road bump on the highway to future prosperity. What is a bit more concerning, however, is that with Mark Zuckerberg taking a hardline stance against a platform policing what many view as political rhetoric, racist, or hate speech, many companies are suspending or heavily reducing their advertising dollars on the Facebook and Instagram programs, with Unilever, Coca-Cola, North Face, and Verizon among the biggest names to make the decision so far. It remains to be seen whether the company will ultimately bend to the will of social pressure, but with over $70 billion in annual revenues for the trailing 12 months, it still has a very, very long leash, with the losses so far only mounting to a fraction of the overall pie. What makes Facebook one of the best and safest growth stocks in my opinion is its world-class balance sheet. With $133 billion in total assets and only a meager $32 billion in liabilities, it has so much firepower to acquire smaller companies or even invest into R&D and figure out other avenues for growth. It really is one of the financial marvels of the stock market. Even with its already $600 billion market cap, I'm firmly of the belief that in less than 5 years, we will certainly be talking about Facebook as the next trillion-dollar tech company alongside peers Microsoft, Apple, and Amazon, and Google is right on the cusp of earning that honorific again as well, after losing the mantle due to the pandemic crash. I opened my position in FB somewhere in mid-April when the price was somewhere in the 170 range, so while I am not up a huge margin since that time, it's definitely a stock I'm keeping tabs on and will be eager to add to my position should the price tumble below my cost basis. The next 3 stocks are all e-commerce holdings in my portfolio, an industry as safe as any right now during a prolonged pandemic. First up is a company that has probably been one of the fastest growing stocks on the market since the March dip. Wayfair, ticker symbol whiskey, has become synonymous with buying online furniture in the US in recent years. While the pandemic may have wreaked havoc for many companies, for a small number of outliers such as Zoom, Netflix, and of course Wayfair, it has actually been a huge boon and demand has accelerated significantly. In its Q1 earnings report, Wayfair stated that it had sold 10 million pieces of furniture and generated $2.3 billion in revenue, both of which were 20% increases year over year. And although it has been in the spotlight only recently for its phenomenal performance given the circumstances, the company has undergone significant growth the past few years anyway, reporting total revenues of $6.8 billion in 2018 and a staggering jump to almost $10 billion by the end of 2019. Enviable numbers for any growth company, really. An aggregate of 29 analysts covering the stock, in fact, have collectively estimated sales growth for the entire year 2020 at 36.5%, which implies a greater upside for the remaining quarters if Q1 was only at 20%. Investors, including myself, are hoping that a growth will lead to an increased customer base, which in turn will lead to improved repeat business and winning market share from competitors. Speaking of which, both Pier 1 and Tuesday Morning filed for bankruptcy back in May and have plans to close and liquidate all stores in the near future. Bed Bath & Beyond also recently announced layoffs and is clearly struggling under the pandemic, which if becomes prolonged due to a second wave will equate to even more wins for Wayfair. However, investing into Wayfair admittedly comes with a big caveat despite the mammoth opportunity, as the company is still yet to reach profitable status despite going public 6 years ago, unlike both TTD and Alteryx, and Beyond Meat only marginally unprofitable at this point, but only went public a year ago. Despite the gigantic leap in revenues, the company only managed a dismal negative $3 a share, which actually widened from a negative $2.2 a share a year ago. The company must focus on cost cutting and more efficiently using its resources to turn a profit, and needs to attack these weaknesses sooner rather than later. Rest assured that if management can get this under control, the sky will be the limit for this stock in my own estimation, but that's clearly a huge conditional. After having jumped 9x since the March 23 lows, the stock price has definitely slowed down, but as I opened my position at the beginning of May with a cost basis around 140, I am still well ahead at this point. For investors not yet with the position, however, I would suggest a wait and see approach to this particular stock, as a significant pullback could be on the cards after such an exaggerated run-up and represent a very attractive buying opportunity if/when that happens. Continuing with the e-commerce theme, the next stock in the portfolio is Shopify, ticker symbol Sierra Hotel Oscar Papa. Probably one of the most high-profile stocks of the last few months, as it made headlines for becoming the most valuable company in all of Canada and has really been a poster child for online retail growth during the pandemic. In many respects, Shopify has mirrored both the success and failure of Wayfair, churning over high revenues growth for the years between 2016 and 18, and for the 12 months ending March 31st, 2020, still a mouthwatering 47% year-over-year increase, but it too has failed to post a full-year net profit since it went public in 2015. Unlike Wayfair, however, profitability is right on the horizon, as in the earnings call just this past May, Shopify actually reported positive EPS of 19 cents, smashing analysts' expectations of negative 79 cents. If Shopify really has turned the corner and starts to become a cash cow moving forward, then even at the currently insane valuations of 5,000 forward PE ratio and price to sales of 61, really the highest ratios I can ever remember seeing for a company, there could still be a lot more gas in the tank for the price to run, as investors should continue to pile into the stock until there are signs of revenue growth slowdown, which given the data and the effects of the pandemic might not happen for some time. Similar to the digital advertising chart we looked at for TTD, the chart for e-commerce sales worldwide from eMarketer is projecting significant increase between now and 2023, in fact by approximately $1 trillion every year. While Wayfair has a relatively confined niche of online furniture, because Shopify provides an e-commerce platform for mostly small and medium enterprises, it can span the entire spectrum from basically any good or service that can be sold and will be able to capitalize on the broad market expenditure. According to the US Small Business Administration, there are over 30 million small businesses in the US alone, and with Shopify currently only catering to 1 million of those, there's still significant room to run even within the continental US before accounting for the millions of businesses globally once Shopify inevitably shifts focus and begins to eye those opportunities, similar to how Netflix has pivoted, for example. Skipping over to the chart, we can see how significantly it has already run since the March lows, and fortunately for my portfolio, this was actually the first stock I purchased during the recovery period, and with a cost base somewhere in the mid 300s, while it may be prudent to take some profits at this point, given how much it has already run, I would feel just as comfortable letting this position ride for the next few years at least, and seeing where it ends up once the valuation normalizes, if it ever does. That about wraps it up for this video. If you're keen to see where I've invested the remaining 40%, you'll have to check out part 2. But what are your thoughts on the holdings so far? Post them down below in addition to any other questions or comments. Also, don't forget to hit the like button if you enjoyed this video as well, and even consider subscribing to really support the channel if you haven't done so. Before I go, click on the top video here for part 2 of the post-pandemic growth portfolio breakdown, or the bottom video for a detailed look at the trade desk instead, which was the first holding unveiled in this video. As always, thanks for watching, and I'll see you in the next one.